Most people don't have issues with the IRS because they're doing something intentionally wrong. They have issues with the IRS because they don't know what they're doing. That's the reality. The problem comes down to a few common things that we're gonna go over. And the main problem is by the time they realize all these issues, they already incurred penalties, they already incurred audits, they already incurred interest, all of these issues combined, and they balloon to bigger problems. Hi everybody, my name is Julian Gonzalez. I'm one of the managing partners here at Upfront CPA. I've been in this business for over 15 years. I've worked with clients who've had issues with the IRS, all kinds of issues, whether it's penalties, whether it's audits, whether it's misinterpretation, whether it's amendments, all kinds of issues I've worked with. And today, what I wanted to discuss with you for educational purposes, because this is not a advice for everyone. This is, by the way, disclosure. This is just speaking in general, right? And what I want to do today is based on my experience. I wanted to share with you some of the common issues that I see most often happens that can lead to issues with the IRS, okay? So I wanted to start with some of those patterns with the IRS, right, that cause these problems. And most problems come from, just at the very basic, right? So inconsistent reporting, that's number one. Missing information, right? Positions that don't match what the IRS has. This is very important. And today, so I just want to walk you through some of these common issues, as I mentioned, and more importantly, how to avoid them, right? Because the good news is all of this is very avoidable just by following very simple rules that if you do it correctly, they will be very simple, but if you don't do things correctly how they should be done, they can go from being very simple to like a very, very complex situation, okay? So let's talk about issue number one, which is the income mismatch and underreporting, okay? So this is, it's sort of a surprise to a lot of the clients that I speak to or potential clients that come through my door or that I do consultations with, that they don't know that the IRS actually gets a copy of your income form, whether that's a W-2, whether that's a 1099. So the IRS already knows what you make. So very, very off the top, if you're not following your forms correctly, they can do what is called an unreported income report letter, which basically is going to say, if I have X amount of income reported to you, why are you reporting why? That type of thing, right? They get brokerage statements as well, something that most people are not aware of. They will say there on the forms that they are sending this to the IRS, so they already know what they have. And then with some of the improvements that we've seen with the IRS is that we see they seem to be automating these things, so they're becoming more and more current and more automatically, right? So common world scenarios, right? What happens more often than not, and some of the issues that we see here that happen with regular folks, right? Which is forgot a 1099. Okay, so this is very common, especially with the brokerage one. People are very busy. Usually they come during tax season, kind of rushing through things. They just kind of focus on getting things done quickly, and it's they'll forget a 1099. It happens, right? Crypto or brokerage activity not fully reported, right? This is where you get those statements or you don't get the statement. You're just kind of going off the top, figuring out what you think how it should be done, and then you might get things incorrect and different from what the IRS has, right? Multiple income sources, right? Like if you do side business, if you do consulting, some of these things will create some of these mismatches, right? And then K1s arriving late or not included. Or even worse, when you file your taxes before you actually receive them, and then you don't take the time to amend the tax form. This is very common, okay? So most of the time, right? So this is not intentional, right? It's just disorganization. It's incomplete reporting. Okay, it's normal. It's just kind of sort of like how the nature of the tax filing season can amount to if you don't things correctly. That's why sometimes you'll see us as CPAs, as advisors to you, sometimes trying to slow the process down. And that can sometimes be misunderstood as, okay, well, you're preventing me from doing the things right, or I actually want to file before the extension. Like, why you keep bringing up the extension? And sometimes it's to your benefit, right? Because, like, as I mentioned, so if you don't file all of these things, the IRS will catch that almost automatically, and this can open up a whole can of worms that you don't want. So it actually makes sense that if you need to file an extension, just make sure that you get it right. The priority is to get it right. Obviously not at the expense of not filing, right? Of not just going over even the extension and not filing. We're not talking about that level. We're just saying that you just make sure that you do it to the best that you can, and don't kind of fall into that trap because you didn't know something. Then you get all of these issues, right? So how do we avoid this, right? How do we make sure that this doesn't happen, right? So what we like to do is we like to share a whole checklist with our clients, okay? If you keep a very simple, easy to follow checklist, you can avoid a lot of these problems, okay? Obviously, number 2 will be patience, right? Waiting for all these documents to arrive is key. Okay, some of them come earlier during the year. However, most of them, especially in the case of K1s that are from more of a private resources, they usually come later. Okay, because some of these companies have to go through a whole process through year end to complete the financials that they need to sometimes audit the financials that they need to complete before they can issue those K1s. So naturally, there's going to be, some delays on their part, right? Use proper bookkeeping if self-reporting. If you're doing a self-employed person, right? This is one of the biggest ones. When it comes to getting delays, right? This is when you show up to your accountant and you've commingled some funds, you're just self-employed, you may not have a bank account. Then it's doing the whole exercise of trying to, at that time, separate a whole year worth of activity between personal and business, right? Which can be a very thorough and very accumulating and big, sort of a big project that needs to be in a very short amount of time, right? So not ideal. So, the IRS is not guessing your income. This is key. They already know what you make. They already know a large portion of it. They may not get the whole picture of every single item that you may get. Sometimes you may get paid in cash, for example. They're obviously, they may not know that if the correct reporting isn't done, but they know the majority of it. So you might as well just get this right, okay? So that brings us into issue number 2, which is overstated and unsupported deductions, right? This is when you're kind of playing that game with your accountant, or like it's, kind of deduct. Can we get creative here? Can you make miracles, right? And sometimes our job as CPAs, or accountants, it can just kind of be misinterpreted as, creating, getting, then you tell us what you think it's a deduction and we'll make that happen, right? Although there might be some truth to that, where our job is to make sure we go through the code and see how, we make sure that if there is a business purpose, then we can allocate it accordingly, right? But, that doesn't mean that you're going to kind of pass that threshold where you're just kind of making things up, where you're just kind of making up expenses, or you're kind of going off of your interpretation of the tax law goes above and beyond what it actually says, and you end up making deductions that don't qualify. All these can be very avoidable, right? So what happens? Okay, deductions claimed without documentation. This is key. This is when you just say, "Oh, I think I did something last year." You just include it. That's a big no-no recommendation. Type of thing not to do. Aggressive positions taken from social media or bad advice. We see this more and more, right? It used to be the old school way, the traditional way used to be my cousin said, or a friend of a friend said. Now it's more like, oh, I saw it on TikTok, right? And all these social media kind of things get taken way out of context, and they can spread like wildfire, right? And in this business, in the tax world or in this industry, it's very unlikely that all situations, although you can fall under a situation where you could be very similar to, like, let's say a group of people, right? Let's say all W-2 earners, although that they may be different in nuances way forms. Most of them they're very similar, right? It's when we get into more of the business or self-employed entrepreneurship things that can just just already put you in a whole different level. But still, everyone's different, every situation's different, and when you hear somebody or a group of people providing like blanket advice as though that would apply to just about everyone, you have to be very cautious with that. Usually tax codes are presented for very specific types of income or very specific types of industries or professions and stuff like that. So that has to be or should be disclosed, but it is rarely the case, I want to say. So blurring personal and business expenses, right? That's the commingled stuff I spoke about that is kind of common, especially for the self-employed, that naturally kind of happens there, right? So some examples of those, right? Very like just off the top, meals, right? Travel, business expenses without logs. I did that. I went there. I didn't take my card. I just paid cash. All these things. They should be documented to the extent that you can, right? At least some log, some way to document what you did, where you went, and why. If you met with a client, for example, during the meal, that's all very acceptable. But there are so many ways that you can document this, whether it's going, through an app where you can just kind of go through it and apply the expense at that time, even copying, taking a picture of the invoice is a popular one. Any type of login will do. Okay, so home office deductions that don't meet requirements. And this is a big one, especially after COVID, right? Because what happened is, we were all kind of just all work from home. We're forced to work from home, most people. And what happened was this home office deduction kind of became more and more popular, right? But we're used more often than they were before. And then the IRS took a notice on this. And the requirements for these home office deductions are very specific. You have to follow a very strict set of rules, whether it's the square footage, how you calculate it, whether it's what consists or what is allowed as a presentable office, or what you can actually have it as an office, whether it's that you cannot have it as, for example, it cannot be next to your bed, or something that you can use in another form other than the business. So there is a whole other video that I done about this, and I will share with you guys, but about the specifics of the home office deduction. And it's very important that you listen to that one, because this is a very misunderstood deduction that I've seen that a lot of people think that it's can easily just be taken, and they don't know that it has quite the list of requirements that need to be follow, right? So writing off personal expenses of businesses, right? That's very common. It's one of those that is the combination of just about everything I just mentioned, right? When it comes to meals, when it comes to travel, whether it's those things that it can go either way, right? Because there's, when you're paying certain invoices, I mean, clearly they have pretty much no other logical explanation other than for the business, right? It was paid by the business, for the business, to be used by the business, to the benefit of the business. Okay, that's all very clear. But some of them, especially on the expense side, they could go either way. For example, if you go get gas, that could be used either for the business or for personal use. So those need to be documented and need to be separated to the best of your ability, right? Vehicle deductions without mileage tracking, right? This is another one that happens quite often. As you know, because I've already shared a video about this one. If you haven't, go back and take a look at it. Is the vehicle deductions, okay? You can either take the standard deduction or you could take the direct expense, okay? Again, follow my video to get more details about that and the exact rules that would kind of, that will take you to either one or the other, and which one is the best for you at what moment, and what would be the things to follow to make sure you pick the right one. So that's a really very fun and interesting video that you should watch. But whichever the deduction that you pick, you have to track correctly, right? In the case of being the mileage, then the mileage has to be tracked. There's similar to the meals, as I mentioned earlier, there are plenty of options that you can use. There are apps that you can just easily, pick if you're gonna use your truck or your vehicle, whatever the case might be, that you can select if that's for your personal or your business use, and can easily just kind of get, they can get allocated correctly, and it just makes it easier as support for when you go file your taxes. Okay, so people hear about deductions, but the rules, they don't know the rules behind them. They hear, okay, this is what happens, but they don't always hear, or they don't always listen, or they're not being presented to with the information of what it takes to make that rule stick. Okay, and this goes back to what I was mentioning earlier, especially about social media and hearing all these blanket advice. They all sound so simple, so easy, but they don't always provide the whole context and what you need to have either done or what you need to have in place so that you can get these deductions done correctly, right? Because as it's the whole point of the video, is because these things don't happen intentionally. It's because you don't have the whole story, right? So my whole idea here is that you get some context so you're able to make better decisions, right? And that brings me into how do I avoid this, right? Which is the key here. How do we make this not happen? And so just got a few off the top. Right? So keep documentation, receipts, bank records. Those are easy, right? Depends on how you make the expense. Sometimes you pay cash, keep the receipt. Make sure check how it shows up in the statement. It's always good to have a receipt anyways. Just put those in a drawer somewhere, or put them in a box and just throw them in there, and you just keep them there just in case. It's not like you have to keep them on in your wall, especially as they're mounting up. But it's always good to keep receipts. Separate business from personal accounts. This is the most simple one. As you set up your business, especially if you're already creating an LLC or some kind of entity or business company, is to open up that business account. Just start there. That's just gonna be the foundation for now how you're gonna be able to allocate the expenses, right? That doesn't mean that you then cannot use your business expenses, especially if you don't have, let's say, the right, that you have the type of credit limit that you need on your business. But that should be rare, and they should be on some kind of agreement, whether it's an accountable plan, whether it's some kind of loan agreement. That should be in place for you to utilize it. Other than you should not just be kind of randomly picking between your business and your personal. Okay, understand what qualifies before claiming. Okay, just make sure that you know what you are using, which type of, whether it's a credit or a deduction. Make sure you follow the instructions of what the purpose is, how they must be applied, and what you need to do to get that to stick, whether it's in terms of support or documentation that you will need, right? And be consistent year over year. One of the biggest triggers with the IRS for audits and red flags is just having big swings in areas where you should be consistent. Right? That's probably one of the quick red flags that they're gonna have to, that potentially create issues for you. Okay, so a deduction is only as good as your ability to support it. Okay, that's just that's just basic 101 how it works. Even if you're hearing differently from hopefully not from social media and TikTok advice, where you just say, this guy said that, this is ironclad and nothing's gonna happen, I can just do it, and most people don't get audited. That doesn't mean that you won't get an audit. That doesn't mean that you're not being red flag. So you should not kind of take this approach. Okay. So that brings us into issue number 3, which is poor planning and timing. Okay, this is kind of one that I left for last, because this kind of flows into what we like to prioritize here at Upfront CPA, which is the timing of this whole thing, right? Because as I mentioned earlier, the natural sort of operandum when it comes to taxation and timing and deadline and the famous April 15th is, most people don't like to worry about it until it's February, March, and April. Okay, and this is unfortunately not the best way to do things. Okay, it's just basically procrastinating. Is how I like to sometimes mention it, as similar to just waiting 3 years to go to the dentist and just showing up and thinking that it's all gonna be great and fun, right? And in 90% over the vast majority of the cases, what ends up happening is you have to have surgery. You have to do like a deep cleaning. You have to kind of stay over, sometimes stay, extended period of time to the dentist because you didn't go for 3 years. A lot of bad stuff mounted up. It's very similar here. If you wait for the last minute, you're not only passing up on opportunities and strategies because they already expired, but you're also kind of just procrastinating that to the end when you are, perhaps tired, where you may be going through some other stuff, maybe personal issues, and you have to already mount all these added stress because you're now dealing with going back a whole year worth of activities and, putting them up on a very quick do-it-yourself way that it's just not gonna be able to. That is, at the end, it's only hurting you for everything, right? It's not the best case for you, and it's not a CPA that is proactive, that is looking after you, and is making sure that you're doing things correctly, or at least is trying to. Is always trying to just avoid that at all costs. It's just trying to look at a thing. It's gonna try to help you by looking at things proactively and how they can help you throughout the year. If they're just waiting for you to show up in March, usually the service that you're gonna get, the value that you're gonna get out of the whole proposition is usually not the best one, and that's guaranteed. Okay. So taxpayers wait until tax season, as I mentioned, right? That's what the majority of businesses or individuals do. More and more, we're seeing people more open to doing it, just kind of taking a different approach and just meeting with their client, with their accountants, their CPAs more regularly during the year to get things done during that time frame instead of waiting at the end. We're seeing that more and more. And at Upfront CPA, that's the approach we like to take. We like to meet with our clients. We like to give a whole tax advisory plan to show them all the strategies that they can use, the timing that we needed to get done. By the time they do their taxes, all of this is already worked out. All of this has been implemented, and you can see the smile on their faces. You can see how happy they are, how different it is from that whole stressful situation that they were doing before, right? So decisions can be made too late when you wait that long. No estimated taxes paid. Okay, no structure around income and expenses. All of these are things that are just gonna just drag you down. They're just gonna be, problems down the road. They're just kicking the can down the road, as they say. As you if you get into that rhythm every year, what we see is that sometimes they get even worse, right? When it's a situation that it should actually be getting better, with the whole procrastination issue, they actually tend to get worse. So our recommendation is to avoid that at all costs. You don't have to go up front. There are many CPAs and advisory firms that will walk you through this, so you can do this the right way. So you're just not doing this whole vicious cycle. We're just kind of going through this whole thing every year. And you don't have to call us. There are plenty of good advisory firms that can just help you. Give them a call. Just book a free consultation, a discovery call. You have nothing to lose. I guarantee that you will be glad that you at least, made the due diligence to look at the whole, how that works. You have absolutely nothing to lose. Okay, so real examples. Okay, so missing S-corp election deadlines. This is huge, right? Some people think that that they get an automatic S-corp. Or the opposite. They file for an S-corp status when they did no payroll. They're not even considering payroll. It's just they heard it. It's because they heard it on TikTok. Terrible advice. No planning retirement or contributions early. Okay, this is something that you kind of have to plan around your income. This is not that you get an amount just top of your head. Okay, no estimated tax payments or estimates, right? Because tax are due in March and April is when the tax filing is due, but it's not when payments are due. Okay, so payments are actually done throughout the year. That's what the estimates are for, and that's why you need to follow the whole safe harbor rules. To know how much taxes are you paying. Are you paying 100 of the previous year of this year's tax? Are you paying 90% of the prior year's tax? So all this you kind of have to. That's what the whole planning, the purpose of the planning, right? Because you may not notice, but you may actually be paying penalties for not paying your estimates. There's a whole area there on the IRS form 1040 where it tells you if you pay penalties. Most people don't know, or they don't realize that they've actually been paying. We've seen it. Oh no, I didn't pay estimates and I didn't pay a penalty. We've shown them that they actually paid a penalty. It's just all part of the tax filing, and then unless you're looking for it, you may not be able to see it. Okay, so large tax balances, right? And so this is just kind of just those ones that are like. It's just heartbreaking to see, right? Like when you see some of your clients' faces when you actually tell them that they had no idea, not only that they had an amount due, but that it was that big, for example, right? For generally speaking, I think people have an idea. They think of a number maybe around 20%, which is the effective rate, somewhere around there that they think of. But there's some people are not used to. Maybe you made it's possible that you were maybe a W-2 employee for a long period of time. Now you switch over to doing self-employed or part of a business, and now you have to kind of worry about paying what your taxes. Now your taxes may not be being withheld from your payroll. So you actually have to kind of worry about how much you're gonna pay taxes because it wasn't part of your paycheck, as they were before. So these things can happen, right? And what we don't like to see is you showing up to your accountant on around March, April, worst case, and then not only that, but now you kind of find out or realize that you have a big amount due to pay to the IRS, right? I just kind of lay down a worst case scenario there, and it happens more often than you think, okay? And it's just one of those that it can sneak up on you. To anybody that is kind of just changing situations, okay? So most people treat taxes as like a one-time, once a year situation, but in reality, most decisions happen throughout the year, especially the good decisions, the ones that will benefit the most are those that are presented to you, but you have to be proactive. You have to do them throughout the year, okay? So how do we avoid all of these problems, right? All this like around planning and all these things, okay? So quarterly CPA check-ins. This is very, very one that you can utilize like now. Call your CPA. Hey, do you meet quarterly? Are we able to take a proactive approach rather than just me showing up on March and April? If the answer is no to that, it might be a time to maybe check for other alternatives. Maybe you're really happy with your CPA. Maybe you work with them for a long time, but maybe your situation changed, and it might be worth taking a look to see if maybe you have someone that can take more of a proactive approach. Again, you have nothing to lose. Totally recommend it, right? Mid-year income review. Okay, this is key. You can see what you've done so far, and now we're looking at how we're looking to finish the year, right? You can have an idea that you can share with your CPA. Hey, I have my expectation is that I'm gonna finish the year strong, or I'm expecting that because just for example, due to the economy, I know that things have been slowing down. So I'm actually looking that they might be taking a cut from a prior year or from how things were kind of progressing, and it might digress a little bit. So all these things are. Is the conversation that you need to have around a mid-year review that can actually help kind of work those decisions around what you've done so far and what you're looking to do that year, right? Estimated tax adjustments, okay? This is where you kind of the same thing, right? Now that you know, or you have an idea, or you kind of have some projections, then we could kind of plan your estimates and your taxes around that, right? And then you do the year-end planning before December, right? This is key because it's around December is when the calendar year ends, and this is when some of those options expire. So it's a very good time to do at least a last just kind of run through with your CPA. Just ask me with them, hey, this is what happened this year. I just want to make sure that I'm doing everything that I can do right now to avoid issues towards the end of the year, right? So by the time you're filing your return, most of your tax outcome is already decided. That's the reality, okay? If you go to your CPA in March and April, all they're gonna do is file your forms. Okay, you can kind of walk, you can talk through different situations, but what it comes down to is just compliance. It's just going through the paperwork that you need to get this all over with. There's very little value in terms of strategies that you could use that can actually help you utilizing actual deductions and staying compliant within the IRS and what the tax law requires. Okay, so I think I just gave you a pretty good idea of how everything just kind of pans out between each other. We just kind of went through some of these common issues, right? Income mismatching was one. Unsupported documentation was another big one. Poor timing, right? Just not doing things at the time that they need to be done is key. So it all comes down to visibility. Okay, so what can I do? What do I need to how does all these come together? Okay, do I have visibility for everything? That's what it comes down to. You can rest assured that if you follow these things, if you get your timing right, the difference that it's gonna make on your tax experience, because it's a whole process, right? The whole experience it's gonna be, it's gonna be so different. You almost not gonna believe just how the only thing that you're gonna regret, possibly, most likely, is that you didn't do it sooner. Okay, I've seen it over and over again. Okay, so a good CPA doesn't just file your taxes. Okay, that's tax filing, that's tax preparation, right? What we do here at Upfront CPA, for example, is track your income correctly, structure your deductions appropriately, stay consistent year to year. Just kind of stay away from the IRS radar as much as possible. Okay, it's just to make sure your tax situation is handled correctly from the start, from the beginning. That's key. If you start kind of adding, just kind of mounting up problems, the harder that it is to get those fixed. So with that, that's a key for us, is getting things right from the beginning. If you're in a situation where you unfortunately were not able to start the right way, we can still get things done, right? We can still fix things. It may require a little more effort. It may require a little more commitment from your side to do certain things, but they can always get done, right? So at the end of the day, most issues are preventable. Okay, most IRS issues, if you do things right, they can be avoided. Okay, they don't come from complicated strategies. Okay, they come from small gaps that add up over time. Okay, it's just not, those little things. It's just putting little, covering up holes little by little, right? It's just like death by 100 steps, right? It's just that problem of little things mounting up. This is key for the IRS. Sometimes you don't see it. Sometimes, every year you're kind of making those judgment calls that you're just kind of going towards, just doing things, getting those quick shortcuts that at the end of the day, they actually hurt you at the end, right? But if you stay organized, right? If you plan ahead, if you have the right guidance, you can avoid all of this. You can avoid all of that, and you can have a very different tax experience. So that's it from me, everyone. I hope you enjoyed this video. If you like what you saw, follow us for more content, and we'll see you on the next one.